money in 529 accounts grow and can be distributed tax-free, but if distributions are taxable, only the earnings portion can be taxed. To determine how much of your earnings will be taxed, you must calculate the adjustable qualified education expense, also known as AQEE. It equals total qualified education expenses minus tax-free educational assistance minus qualified expenses covered by education tax credits. Tax-free educational assistance can be scholarships, Pell Grants, fellowship grants, veterans educational assistance, employer-provided educational assistance, or any other tax-free money received, excluding gifts and inheritance. Education tax credits can come from lifetime learning credits or the American Opportunity Tax Credit. To begin our example, let's name our beneficiary. I'll call him Rashid. 2 years before he was born, Rashid's parents created a 529 account for him. Between then and his first year of college, the account's balance grew to $27,000 from $18,000 in contributions. Throughout the first year of college, Rashid accumulated $8,300 worth of qualified education expenses and received $1,600 as a gift from his parents, $3,100 in tax-free educational assistance, and claimed an American Opportunity Tax Credit worth $2,500 for $4,000 of qualified education expenses. Rashid also received $5,300 in distributions from his account, $950 of which was earnings. To find the amount of earnings and distributions, he reviewed his 1099-Q form. With that knowledge, he can determine if his distributions are taxable, and if so, how much. Before I illustrate Rashid's situation, I'll show you the formulae he needs in order of their use. Step 1. Calculate AQEE. Step 2. Calculate how much of the earnings portion of the distributions are tax-free. Tax-free earnings equal total earnings distributed times AQEE divided by the total amount of distributions. Finally, step 3, determine how much of the distributed earnings are taxable. Taxable earnings equal total earnings distributed minus tax-free earnings. That answer is then added to the beneficiary's income. Now, back to Rashid. Step 1, his AQEE is $8,300 minus $3,100 minus $4,000, which equals $1,200. Step 2. Tax-free earnings equals $950 times $1,200 divided by $5,300, which is $215.09. Step 3. Taxable earnings is $950 minus $215.09, equaling $734.91. Thus, Rashid must report $734.91 as income for this year. Generally, if you receive a taxable distribution, you must pay an additional 10% tax on the amount included in your income. But his tax does not apply if it's included in income because a beneficiary dies, becomes disabled, attends a U.S. military academy, receives tax-free educational assistance, or claims education tax credits. In Rashid's case, since earnings are taxable because qualified education expenses were reduced by tax-free educational assistance and an education tax credit, the 10% additional tax is waived. You may realize that Rashid's $1,600 gift from his parents is nowhere in the calculations. That's because AQEE doesn't take into account gifts.